When you're looking at investing money in the stock market, it's often easy to see which sectors are going to do really well, whether you're talking about individual performers like Apple or Tesla, or whether you're talking about technology or healthcare. However, sometimes the biggest gains can be made in the sectors that no one likes. In fact, some of the best sectors to invest in and some of the best successes I've had in the past are ones where everybody hated that sector. When you're talking about 2022 with the market selling off in a pretty spectacular way, it can feel like every sector is hated, but that's actually not the case. In order to find a sector that truly is hated, you want one that's beaten up more than any other sector that's available. For this video, I've scoured the entire market, and I think I've found 3 sectors that no one likes, that everybody hates. So let's take a deep dive and see what happens when we look at sectors that everyone hates. Let me start by showing you an example of a sector that I invested in when it was hated and how it performed since that time. Energy, or the oil sector. You might think that the oil sector is actually hated right now, since it has sold off more than 17% from its recent high to the low right before the recording of this video, but that's actually not the case. If we look at the energy sector in the past, you can see that it has many more significant sell-offs than it has at this time. For example, if we go back to the health crisis in 2020, you can see that the energy sector, specifically US oil prices, dropped more than 70% in just 58 trading days from the high in January of 2020 to the low in March. So while the recent sell-off of more than 17% in terms of oil prices is significant, it is nothing in comparison with sectors that are truly hated, whereas oil was really hated during its March sell-off. Given how much media coverage Bitcoin and the cryptocurrency space has seen lately, you might think that crypto was one of my 3 hated sectors, but it actually isn't. Even though from its high of $69,000 to its low around $17,600, Bitcoin did sell off 74.52% so far in 2022, that actually isn't a hated sector. Not only is there still an incredible amount of bullish sentiment about Bitcoin, you'll also notice historically that during a crypto winter, a period of time when Bitcoin sells off significantly and sees a lot of bearish price action, the average sell-off is actually over 84%. So even though it has sold off more than 74.5%, that's not low enough. It isn't a hated sector in my opinion. My first hated sector is cannabis, particularly the United States cannabis sector. Since Congress has been dragging its feet on legalizing cannabis on a federal level, there has been nothing but bearish activity in the cannabis space. And one of the biggest cons that will be facing any potential investor in this space is that until Congress legalizes cannabis on the federal level, we're going to see nothing but more downside. Not only that, but you must always remember that you should only risk money that you're willing to lose in its entirety. Even though I invest in all of these hated sectors using ETFs and not individual stocks, that doesn't mean the ETF could not go under. Even though the chance of an ETF going under is very slim, you must keep that possibility in mind whenever you invest in any of these. Never risk more money than you're willing to lose in its entirety. For the cannabis sector, I have 2 ETFs that I use for this. The Amplify Seymour Cannabis ETF with the ticker symbol CNBS, and the Advisor Shares Pure US Cannabis ETF with the ticker symbol MSOS. You can see that just from its high in February of 2021, CNBS has sold off a total of almost 83% from its high to its low, so it has been beaten up significantly. Similarly, if you look at MSOS, you can see that it's also been beaten up, dropping nearly 81% from its high to its low. So the cannabis sector is extremely hated right now. My next most hated sector is gold, the precious yellow metal. Even though gold itself has been relatively stable through 2022, the gold miner stocks have been positively beaten up and are actually quite hated right now. However, unlike the other 2 sectors that I have in this portfolio, they aren't as hated as they have been historically. So you need to remember that the potential for even more downside is very high in both of these ETFs. In addition to offering a lot more upside and downside, the gold miners actually carry a attractive dividend yield. So in addition to being able to have a greater exposure to the volatility of the price of gold, you actually get paid over time for holding the ETFs. And in this case, I have two choices. I have the low risk ETF, GDX, which is the Van Eck Total Gold Miners ETF, and I have the higher risk Junior Gold Miners ETF, which is GDXJ. The senior gold miners who've been in the space for a long time choose not to discover on their own anymore, and those are the ones that are represented by GDX. The smaller gold miners, which are referred to as junior gold miners, are the ones that go out and explore. Now, it's much higher risk. If something goes wrong and their mine collapses or they lose the permits, these individual gold miners can go out of business entirely, which is why I choose to use the ETF instead of individual stocks. And it's important to remember that even though I use the ETF, there's a lot more risk in the junior gold miners than there is in the senior gold miners. It will see even more of a sell-off than even GDX sees when gold goes down in price. Currently, when you look at GDX, you can see that it's sold off nearly 32% from its high to its low in 2022 alone. However, looking historically, you can see in the past that it's sold off 37.44% in 2021, and during the health crisis sell-off in 2020, it sold off almost 50%, dropping 49.18%. But that's not even the worst of it. If you go back to 2012, you can see that GDX sold off a total of 81% from its high to its low. So although this sector is hated right now, you need to plan for the potential of significantly deeper downside. You can see that the story is similar for GDXJ. Currently, it's sold off more than 34.5% from its high to its low, and in 2021, it sold off nearly 50%, selling off 48.48%. During the health crisis in 2020, GDXJ sold off nearly 58% from its high to its low, so you can see comparatively just to GDX how volatile GDXJ is. And just like GDX, if we go back to the 2012 sell-off, you can see that it sold off a spectacular 90.6% from its high to its low. So once again, you need to plan for that downside. The junior gold miner ETF could go much lower than where it is right now, even though I do consider this sector hated. My next most hated sector is one that many stock investors don't even think about investing in: the bond market. For this absolutely hated sector, I have two different kinds of investments that I use personally for exposure to this: a very conservative investment and a very risky investment. For the very conservative investment, I use the Vanguard Total Bond Market ETF with the ticker symbol BND. You can see by looking at the chart, since its high in 2020 to its recent low in 2022, the BND sold off a total of 18.29%. And for anybody who's been in the stock market for a long time, you might think, wow, 18%, that's not really that big a sell-off. But when you're talking about the most stable asset class that's available, that is absolutely epic. In fact, to give you an idea of exactly how epic the current sell-off is in 2022, during the great financial crisis, one of the worst sell-offs we've seen in any equity or bond market in the history of the markets, the Vanguard Total Bond Market ETF only sold off 16.07%. So once again, seeing that in 2022, BND has sold off more than 18.2%, that's a huge sell-off. In fact, it's historical. Of course, this doesn't mean that there isn't more downside ahead for BND, but it means that you're getting in at a good level by buying now. This next investment might not just be risky in terms of the bond market, it may actually be the most risky asset that I talk about in this entire video: the iShares Corporate High Yield Bond ETF with the ticker symbol HYG. You might not be familiar with the concept of a high yield corporate bond, but let me use it in the name that it used to be called: junk bonds. In other words, these were considered garbage. These are the high risk corporate bonds that might not get paid out. However, what you get from this is a much higher yield. Whereas the BND currently pays about 1.78% annually, HYG pays 4.91% annually, and the payouts for both BND and HYG are made on a monthly basis. However, when you're talking about high yield corporate debt, you have to remember the risk is much greater too. And you can see from its high to its low in 2022, it's already sold off more than 17%. And again, that's a big figure for the bond market, but when we look historically, you can see that that's not as big as HYG has sold off in the past. In the 2020 health crisis, HYG sold off 23.73% from its high to its low. And during the great financial crisis, as you might imagine, the riskier bonds really really sold off, and HYG sold off 42.24% from its high to the low in 2008. A sell-off of 42% would be considered pretty epic in any individual stock, but when you're talking about a bond product, that's absolutely insane. So if you do decide to get into HYG, you have to remember a sell-off of up to 42% is possible. So now that we've covered my 3 most hated sectors, how do you even go about buying them? For me, I always buy in stages. So I set the amount that I'm willing to lose entirely in an investment in advance, and then I look at the chart to find levels in the past where I can buy in stages over time. If it never sells off lower and ends up going higher, then what I have is what I have, and I take the rest of the money I would have put into that investment and put it elsewhere. However, if you'd rather not look at the charts, you could always dollar cost average in. Just like buying in stages, you choose a set amount that you're willing to lose in its entirety, and then you divide it up into smaller quantities. Then you pick a day of the week or a day of the month, and every time that day comes up, you put a small amount in until you have that allocation that you've desired from the beginning. It's always important to remember that there's risk involved in any investing, but when you're talking about investing in hated sectors, the possibility that they could go from hated to bankrupt is always there. So make sure you never risk more money with any investment than you're willing to lose in its entirety. You have to be able to afford to lose all of that money. If you enjoyed this video and you'd like to see more, please like and subscribe. To learn more about long-term investing, check out some of my other videos here. Thank you for watching, and I'll see you in the next video.